Physical Gold Fund presents the Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to our first webinar of the new year with Jim Rickards in the series we're calling the Gold Chronicles. Jim is an investment banker and investment advisor based in New York, and he also serves on the Investment Advisory Committee for the Physical Gold Fund. Jim is the author of the New York Times bestseller Currency Wars, The Making of the Next Global Crisis. And most recently, he's the author of The Death of Money, The Coming Collapse of the International Monetary System, also a New York Times bestseller. Hello, Jim, and welcome.
Hi, John. How are you?
I'm great, thanks, and I'm looking forward to today's webinar. We also have with us Alex Stanczyk of the Physical Gold Fund. Hello, Alex.
Hi, John. Great to be here. Thanks.
Alex will be looking out for questions that come from you, our listeners. So let me just say that your questions for Jim Rickards today are more than welcome. You can post them at any point during the interview. You'll see a box on your screen for typing in your question. And as time allows, we'll do our best to respond to you. So, Jim, in this first webinar of 2015, let's take a look forward. Why don't we start with the Federal Reserve? They've made it clear they'd like to raise interest rates, but they're holding back for now. So there's what looks like a push-pull going on here. Let me ask you two related questions. What happens if the Fed does raise rates, and what happens if it doesn't?
Well, those are great questions, John. It's unfortunate that we, in fact, have to be spending so much time on the Federal Reserve. You're right. It is the right place to start. It's the key to understanding a lot of what's going on in markets. Sort of nothing is more important. I just wish that weren't true. I wish the central banks could go back to just being sort of boring, opaque, marginal institutions that, took care of money supply and acted as a lender of last resort instead of these monstrosities that seem to manipulate and invade every corner of every market in the world. But unfortunately, that is what we have. When you manipulate the dollar and dollar interest rates, you are directly or indirectly affecting every market in the world: equities, gold, real estate, other commodities, junk bonds, corporate debt, etc. So it is the biggest question, but I wish it were otherwise. So let's just take your two scenarios. What if they raise rates? What if they don't? I'll address both of those directly, but I'd like to just spend a minute on the background to help the listeners hopefully understand kind of what's behind the debate. Now, the Fed has certainly signaled that they intend to raise rates. There's no question about that. That is what the Fed has signaled. That's what the markets expect. Securities around the world, equities, bonds, etc., are priced as if the Fed were going to raise rates. I've never seen anything more trumpeted or more advertised, I think, in my career. And by the way, there's good reason for that, because the last time the Fed raised rates was 2006. Now, they hit bottom in terms of cutting rates in late 2008. That's when they got to zero, and they've been at zero ever since. So it's been 6.5 years at zero. But you have to go back 2 years before that to find the last time they raised rates. So it's kind of going on 9 years at this point. So that's a long time without a rate increase, and maybe people forget how nasty they can be. I was in the markets in 1994 when the Fed raised rates, and it was a wipeout. That's when we had the bankruptcy of Orange County, California. We had other dealers went out of business. I mean, that was a bond market massacre. And the same thing happened in 1987. A lot of people recall the stock market crash of October 1987, when the stock market dropped 22% in a single day. That would be, by the way, in today's market, that would be the equivalent of over 3,000 Dow points. Imagine the market dropping not 300 points, which it would get everyone's attention, but 3,000 points. That's what happened in 1987 in October. But before that, in March of 1987, there was a bond market crash. The bond market crash preceded the stock market crash by about 6 months. So these things can get nasty, and like I say, it's been a long time since the last one. So that's why the Fed is talking so much about it. You have to go all the way back to May of 2013, when the Fed was still printing money, buying bonds, long-term asset purchases, as they call it, when Bernanke, at the time the chairman, first started talking about maybe they would begin the taper. That was the taper tantrum, and markets had a rough time. They didn't even do anything. They didn't cut purchases, and they didn't raise rates. They just talked about it, and the market threw a benefit. And then, of course, through the course of 2014, we had the actual taper. Now the taper's over. QE3 is officially over. But so this thing has been really advertised for 2 years. Well, there's a reason for that. And the reason is that when rates were zero, why were they at zero in the first place? Because the Fed was trying to pump up assets. They wanted borrowers, they wanted banks and other borrowers to go out, borrow cheap money, and buy houses, buy stocks, bid up the price of assets, create the wealth effect. Hopefully, that would make people feel richer. They would spend more money. The economy would get on a self-sustaining path. That didn't happen. The asset prices did go up, but the wealth effect did not kick in. The economy is still very weak. The Fed did not get the kind of 3.5–4% growth that they were really hoping for when they started all this. I think if the Fed had it to do over, they never would have gone down this path, or at least not stayed on it this long. But because they had encouraged everyone to borrow money and lever up and do maturity mismatches, so you borrow, overnight in the repo market and you go out and buy some risky asset like stocks or other assets, they wanted to give people lots of warning. Hey, we're going to raise rates because I can borrow overnight. If I'm a dealer, I can borrow money overnight in the repo market, go out and buy a 10-year note, which until recently was about 2%. So I have zero cost of funds and I make 2% of my 10-year note, but I could leverage that trade 10 to 1 because I can get more than 90% margin in the repo market. So a 2% profit levered 10 to 1 is a 20% return on equity with a government security as my asset. It's not like I got to go buy some junk bond. So as long as rates were at zero, it was pretty easy to make 10, 20, even 30% returns on equity with a highly leveraged trade. You say, well, that sounds a little too easy. What's the risk in the trade? Well, there's no credit risk in the trade because you've got a treasury as your asset. The risk is that they raise short-term rates, that while you're sitting there with overnight money holding a 10-year note, all of a sudden the overnight money gets to be more expensive and that trade's upside down and you're losing money. What the Fed was doing is they said, hey, we encouraged everyone to do these crazy carry trades, do these maturity mismatches, make a lot of money, rebuild a bank balance sheet, but the time will come when we're going to raise rates and we're going to give you years literally to get out of the trade or wind it down or hedge it. And anybody who's caught out, shame on them, as you can't say you weren't warned. So the Fed wants to raise rates to normalize things. They've been talking about it for almost 2 years because they wanted to give people plenty of warning. But markets don't listen so well. At least there's always somebody who doesn't get the message. And as I look around, there's still a lot of leverage in the system, enormous leverage in the stock market, enormous leverage in various carry trades around the world. Chuck Prince, then the CEO of Citicorp, said prior to the last world financial calamity, he said, you have to keep dancing as long as the music's playing. And there's some people who literally either won't listen to the Fed or don't believe them, et cetera, and are still going to be in these trades. So the short answer is, I expect a lot of market disruption. I think they might throw the U.S. economy into a recession because the economy is fundamentally weak. I think some people have been smart enough to get out of these carry trades, at least based on the Fed's warnings, but some people have not. They'll get a rude awakening. They may have to unwind those trades quickly. You may see a lot of liquidity pressure. We're seeing it anyway, by the way. We're seeing it just on the talk. Imagine the reality of actually the Fed raising rates for the first time in 8 years. So I think we'll have a very bumpy ride. I don't think it'll be a soft landing. And beyond that, the whole idea that the Fed would raise rates was based on a forecast that the economy was getting stronger and we would sort of achieve self-sustaining growth. But nobody in economics, nobody on Wall Street, nobody on the buy side, nobody in academia, nobody I've seen anywhere has a worse forecasting record than the Fed. And I don't say that, out of spite or to try to embarrass anyone. It's just a fact. I mean, they year after year after year, they produce these very high growth forecasts. Every year they're wrong. They're not just wrong by a little bit. They're wrong by orders of magnitude. So when the Fed says, well, we think the economy is healthy enough for a rate increase, that's the first sign that it's not. But beside that, there's a lot of data. We're seeing, auto loan defaults go up. Real wages are stagnant to down. Labor force participation continues to be very low. Our trade deficit's getting worse, partly because of the strong dollar. Emerging markets are slowing down. China's slowing down. Europe's slowing down. I think it's nonsense to think that somehow we would be closely coupled on the way up, but somehow the rest of the world's going to go down and the U.S. won't be affected by that. So the growth is weak. So not only would I expect some disruption from the rate increase simply because people don't listen or they're greedy or they stay in the trade too long, but I would say the Fed's got the economy wrong and they're going to increase rates into a very weak economy. So I would expect probably throw the U.S. economy close to a recession, more deflation, and probably some disruption in equity markets. The one market that might rally actually is the bond market. 10-year notes are still, I think, pretty attractive based on everything we see. Now, that's if they raise rates. Let's flip that around and talk about what happens if they don't raise rates, because that was the other part of your question. Very, very few people expect this. I actually don't think they will raise rates, and I've been saying that for quite some time. More people are kind of jumping on board that bandwagon recently. I've been talking about it for about 6 months. I did a bunch of interviews in the fall where I said I did not think the Fed would raise rates in 2015. We can debate 2016. That's still pretty far away, but let's just talk about 2015. My view is the Fed will not raise rates. More people are coming over to that view. By the way, if you go back 6 months, so just go back to last summer, the debate was, well, the Fed's definitely going to raise rates in 2015. The only question was, would it be March or June? And I was one of the ones saying they won't do it. Well, here we are. It's January. Nobody's talking about March. Even Janet Yellen said they weren't going to raise them in March. So now you have your April people and your kind of June, July people, but you're hearing more and more people, oh, well, maybe it won't be September until September. Bill Gross recently said he expects it in December. Well, tell me the difference between December 2015 and January 2016. Not much of a difference. So we're starting to hear a lot of doubt about whether they will, in fact, raise rates. My view is they won't. I base that on what I expect the data to show. And by the way, I don't have a crystal ball. It's not like I'm sitting inside the Fed boardroom over here in the chit-chat. I'm basing this on what the Fed itself says. They say that the decision is data dependent. If you look at the data, it's coming in weak. I know we had this gangbusters third quarter GDP, but there's a lot of noise around that, and it doesn't appear to be sustained. It looks like certainly fourth quarter will come in a lot weaker, and first quarter 2015 may be weaker yet. And we're still not seeing any pulse in the thing that Janet Yellen pays most attention to, which are real wages. Real wages are stagnant. And remember, the Fed has a dual mandate. It consists of trying to reduce unemployment or create employment, depending on how you want to put it, and price stability. Well, sometimes those things are in conflict. Sometimes they have to roll the dice on inflation a little bit in order to create jobs, and other times they have to stifle job growth in order to damp down inflation. So you can't always do both of them at once, but sometimes you can. And what's the one piece of data where both parts of the dual mandate come together? One thing you can look at that sort of tells you something about both. The answer is real wages, because real wages are, if real wages are going up, that's a sign of inflation, a leading indicator of inflation. But it also tells you that the labor market's pretty healthy, because employees cannot get a raise. They cannot demand a raise from their bosses or their companies unless the labor market's tight. So real wages is the number one thing Janet Yellen's looking at. Guess what? They went down. They're going down. There doesn't seem to be anything indicating, at least as far as the data is concerned, that they should raise rates. And I think this is just the result of bad forecasting. They always forecast stronger growth than we actually get. By the time they catch up to the reality of their forecast, they find out that we're nowhere near what they expected. Now, this is interesting because the market is set up for a rate increase. What if they don't? And my expectation is they won't. I think we'll get to the summer and the data will be lousy, and the Fed will make it clear that they're not going to raise rates anytime soon, and that this patience will just turn into more patience, using their new favorite buzzword. They seem to come up with new buzzwords every 6 months or so. But anyway, once it becomes clear that they're not going to raise rates, I think the markets might say, you know what? Maybe they can never raise rates. We did QE1, QE2, QE3 Part 1, QE3 Part 2. And then they promised to raise rates, and then they can't do it. It wouldn't surprise me to see QE4 in early 2016. What may happen then will be very interesting, because the stock market could actually rally on that. It won't be rallying on fundamentals. It'll be rallying on cheap money. But the market's expecting tightening. If they get ease, or at least no rate increase, and the possibility of more ease in the form of QE4, markets might even rally. So, you might see stocks. I'm not a big stock market bull, but if the Fed doesn't raise rates, and my expectation is they won't, you might actually see stocks higher at the end of the year than they are now based on more free money. But I think by then the inflationary expectations will start to ratchet up, and that's probably good for gold as well. So it could be one of those periods in the second half of this year when gold and stocks go up together for the same reason, which is it's just apparent that the Fed has no way out of this dilemma.
Well, I'd like to pick up on one element of that you mentioned right at the end there, and that's the dimension of inflation. So could you just spell out how you see the impact on inflation of this trajectory that you are forecasting?
As I've said for years, John, and of course this goes back to literally the first couple pages of my first book, Currency Wars, which came out in 2011, but nothing has really changed my view since. The way to understand the global economy is we have inflationary and deflationary forces going on at the same time, and they're pulling against each other exactly like two really strong teams in a tug of war. I've used that metaphor before, but I think it's a good one because, if you watch a tug of war at the beginning, let's say, but the teams are pretty evenly matched, not much happens. You got one strong team pulling one way, you have another strong team pulling the other way, and nothing's moving. Now, there's enormous tension being exerted on the rope. There's a lot of force involved, but nothing happens right away. Now, eventually, one team wears out the other, and the losing team collapses, and they get pulled over the line, and the outcome becomes clear, but it's not clear at the start. So the natural state of the world, and I think we're seeing a lot of visible signs of this, but it's been true for years, is deflation. There are three main reasons why the world wants to deflate. The first one is just demographics. Workforces are aging, people are retiring, they're spending less, saving more, or there are just fewer people around in places like Russia and Japan. It's not a question of birth rates slowing down, the population is actually declining. But China, of course, with the one-child policy, their population is leveled off. The only reason the U.S. has some population growth is because of demographics, but our baby boomers are, they're, I forget how many thousand are turning 60 every day. So demographics is one thing. The second thing is technology, and I don't need to belabor this, but I think we all understand that we're all more productive with computers and technology and the web, but that means that people who used to hire an assistant or a couple staffers don't need them anymore. So that's a driver for fewer job gains and it's deflationary. The final one, in addition to those two, is deleveraging because of excessive debt, which we're still working our way out of. I know it seems like a long time since the financial panic of 2008, but in fact, there was so much debt in the system, and there still is, by the way. There's been a lot of deleveraging in the private sector, private balance sheets, but that's been accompanied by increased leverage in the public sector. So all we did really was substitute government debt for private debt to some extent because of the bailouts. What that means is that the system's still pretty highly leveraged and has a tendency to deleverage. So take demographics, technology, and deleveraging. Those are three deflationary forces. Now, on the inflationary side, of course, what we have is money printing by all the central banks. And we've talked about the Fed quite a bit, but you look around, the ECB, the Bank of England, Bank of Japan, People's Bank of China, they've all leveraged just as much as the Fed. Some more than others, but People's Bank of China has printed more money than the Federal Reserve in the last 5 years. So you've got the inflationary force of money printing by central banks offsetting the deflationary force that we just mentioned, demographic, technology, and deleveraging. And these two powerful forces are fighting against each other. Now, right this minute, deflation is winning. We see it in the oil prices, commodity prices, gasoline at the pump. We see it in a lot of indicators everywhere. But the central banks have not stopped trying. Central banks have to have inflation. There are reasons having to do with managing sovereign debt, tax collections, bank balance sheets. We could spend a whole hour just on why central banks have to have inflation, but they do. And so what does it mean when central banks want inflation, but they're not getting it? When central banks and governments have to have inflation, but the natural state of the world is deflation? Well, what it means is they have to try harder. If they printed all this money and it hasn't worked yet, then probably got to print more, which is one of the reasons I don't expect them to raise rates in 2015 and may even come back with QE4. Now, this is very, very difficult for investors, needless to say. If I told you that we're going to have inflation, everybody would know what to do. You wouldn't need much investment advice. You'd buy some gold or art or, hard assets or, get out of cash, et cetera. You would know pretty much what to do. If I told you there was definitely going to be deflation, likewise, you would know what to do. Cash, bonds, certain other things do very well in deflation. But the problem, of course, is that we've got both, and one can prevail for a short period of time, but the other one never really goes away. So I think the best way for investors to deal with that is to have a balanced portfolio, a diversified portfolio that has a combination of all the things I just mentioned. You're not going to win on all those trades, but you'll win on a lot of them, and at least you won't get wiped out. You won't be on the wrong side of a tidal wave when it comes. So some mix of inflation protection, again, in the form of gold and fine art and land and energy assets, and some mix of deflation protection in the form of cash and high-quality government bonds. That's a barbell approach, but by the way, the guy who has that is Warren Buffett. Warren Buffett has exactly that kind of portfolio. He's buying railroads and oil and natural gas to hedge inflation, but he's got $55 billion of cash to hedge deflation. So I think that's the right approach. It's not as sexy as, putting all your chips on one side of the table, but it's a lot more prudent because we don't know how this is going to turn out, and you need to be prepared for both.
Well, looking beyond the US for a moment, Jim, there are murmurings of a coming credit crunch in China. Do you think that's likely? And if so, what are the global implications?
Well, I think not only is it likely, John, I would say it's already here. It's being finessed by the central bank, but real estate prices are in full-scale decline. We know that they've conducted a $1 trillion Ponzi scheme under the name of wealth management products. Wealth management products, or WMP, kind of a funny sounding name, but when a middle-class Chinese person, so we're not talking about the multi-billionaire oligarchs, and we're not talking about peasants, we're talking about the kind of rising middle class, which numbers in the hundreds of millions. When they go down to the bank to make a deposit from their savings, they basically get zero. It's the same as in the U.S. They get a very, very low interest rate. But the bank will say, well, we've got these wealth management products. They're paying 5, 6, 7%. Well, of course, a lot of people think, 6% sounds a lot better than zero, so they take the wealth management product. What they don't realize is that these wealth management products are structured products, not that different from our mortgage-backed securities or CDOs, collateralized debt obligations, etc. They are not guaranteed by the bank. A lot of people think they're guaranteed by the bank because they buy them in a bank office, but they're not guaranteed by the bank. And the money goes to these real estate projects, which are being used to build empty apartments and empty office buildings in empty cities and empty stadiums and empty train stations and everything else. And I've been to China and I've seen this firsthand. I know a lot of the listeners have certainly heard about it or seen pictures, but you actually have to go there and get some mud on your feet out at some of these construction sites, and it's amazing what's going on. And then when people do want to redeem them, they just sell a new one to the next sucker in line, and maybe you get your money back if you were smart enough to cash out, but then they just, as I say, sell it to the next person and use that money to replace your original investment. But there are over $1 trillion of those, and that's starting to implode. Real estate prices are going down. Now, China has $4 trillion in reserves. They're in a good position to bail it out, but it's still very costly in terms of how that's going to play out. But on that point, John, I think a credit crunch in China is happening in slow motion, and we need to watch it. But it's important for listeners to understand there's a credit crunch going on all over the world, and it's partly because of the strong dollar. Now, you've got two sets of borrowers out there who are starting to go into pretty deep distress. One is in the energy sector, and I think a lot of people know about this. Obviously, with the price of oil going from $100 to about $45 today, we'll see where it levels out. But a lot of money, and we're talking trillions of dollars, was borrowed on the assumption that oil would be over $80 a barrel. Some of these projects were kind of priced out with oil well over $100 a barrel. Well, with oil at 45, 50, even as high as 60, those projects are not profitable, and a lot of those bonds are going to default. Now, in addition to that, you've got trillions of dollars of emerging markets corporate debt. I'm not talking about sovereign debt. I'm talking about companies in places like Mexico, Brazil, Indonesia, Turkey, South Africa, certainly Russia and elsewhere, that borrow dollars. Now, remember, they're not central banks, so they can't print dollars, and a lot of their business is conducted in their local currency. It could be Turkish lira, Russian rubles, or Mexican pesos, so they don't even necessarily earn dollars. Some of them do if they're exporters, but a lot of them don't. And yet they've got these dollar liabilities, and the dollar is getting stronger, which means they need more of their local currency to convert to dollars to pay off the debt. So that debt just got a lot more onerous. That's if they can even get the local currency. Some of these central banks may run out of hard currency. And of course, Russia is a prime example of that. Russian reserves, hard currency reserves, are probably enough to pay off their sovereign debt, but they're not nearly enough to pay off the corporate debt beyond the end of 2015. So I'm not saying this is a crisis that's going to hit us in the face tomorrow. This could actually take a year to play out. Even a guy who's in the process of going bankrupt might have a little cash in the bank to pay interest for 6 months or whatever. But eventually, if the price of oil doesn't correct and these natural resource exporters don't start to make more dollars, and if the economy continues to stall out, which it looks like it is, they're not going to be able to pay this debt. So we could be looking at trillions of dollars of defaults from energy-related debt and emerging markets debt. That's bigger than subprime was in 2007. The entire subprime market, including what's called Alt-A, Alternative A, which is a kind of subprime loan, but subprime and Alt-A together in 2007 were about $1 trillion. What we're talking about is a market that's closer to $10 trillion. So it's 10 times bigger. Now, it's not all going to default, but even a default rate of 10% or 15%, you're looking at losses bigger than subprime. And that's starting to show up in swap spreads, credit spreads. I mean, we're starting to see it already. It reminds me a lot of what happened in 1997, 1998, where that didn't happen overnight. It took over a year to play out. It started in Thailand in 1997, June of 1997. Who knew that it would end up in a hedge fund in Greenwich, Connecticut by September of 98, 14 months later. But that's what happened. I was at Long-Term Capital Management at the time. That's the hedge fund in question. So I had a front row seat on that fiasco. So I know what it looks like. I know how it feels. And it kind of has that feel right now. We're not at the acute stage, but we do look like we're at the beginning stage. I think that the credit crunch in China is a big deal, but I'm seeing a credit crunch all over the world, early signs of distress, early signs of spreads widening. We could be at the beginning of something that, as I said, may take a year to play out, but it does have that kind of dangerous look and feel to it.
Well, Jim, let's take a moment to look at gold. It turns out that December 31st saw the price down slightly from the start of the year. Does that make 2014 a bad year for gold in your view?
John, I think of gold as money. I know a lot of people think of it as a commodity, and some people think of it as, almost an industrial input or collectible. I don't know, a lot of ways to think about it, but I think of it as money. And whenever I'm asked a currency question, and I get quite a few, as you can imagine, people say, what's the value of the dollar? What's the value of the euro? What's your forecast for Japanese yen or whatever? And I always ask them a question. I say, compared to what? Because none of these things exist quite in a vacuum. They're all priced in terms of something else. And, when you talk about the value of a euro, it's like, okay, well, what we're really talking about is the dollar value of a euro or the dollar euro cross rate. And one thing I know from I think sixth grade math is the dollar and the euro can't both go up against each other at the same time. It's a zero-sum game. If one's up, the other one's down. So when I think about gold, I mean, most investors think of the dollar price of gold. When they say gold is up, they would be like a day like today. Gold's up about $18 an ounce today, pretty strong day. But gold's volatile, has its up days and down days. But so when people say gold's up, what they really mean is the dollar price of gold is up. And if they say gold is down, what they really mean is the dollar price of gold is down. If you look at 2014, was it a bad year for gold? Not at all. It was down slightly, a little over 1% in terms of dollars, but it was up against every other major currency in the world. So if you were an investor based in euros, gold was up. Based in Japanese yen, gold was up. Based in Chinese yuan, gold was up. Based in pound sterling, gold was up. In other words, gold was up, measured in every major currency in the world: Canadian dollars, Australian dollars, New Zealand dollars, Singapore dollars, name one. Gold was up in every single currency except U.S. dollars. Now, I realize that most of our listeners are U.S. dollar-based investors, and so that's how they think about it. But I think it's important not to get too gloomy and to understand that gold was down a little bit in U.S. dollars. But another way to think about it, gold was the second best performing currency in the world, ahead of all the others, except for the U.S. dollar, and it was only down slightly in U.S. dollars. It certainly beat the heck out of Bitcoin. Bitcoin was the worst. Actually, Bitcoin was the worst performing currency in 2014. Russian ruble was second. Everywhere else is somewhere in between. Gold was second best, and dollar was the best. So, to me, this is not really a gold story. It's a dollar story. It's a very, very strong dollar. I guess one way to think about it, John, is considering the dollar's strength against the euro, the yen, and other major currencies, it's amazing that gold held up as well as it did. Gold barely went down against the dollar. So what that really means is that gold and the dollar are harnessed together, at least for the time being, pulling away from all the other currencies in the world. What that tells me is that this is a safe haven trade. The dollar has a bid because of capital flight from around the world, people unwinding carry trades in emerging markets, getting out of China before it collapses, getting out of Russia before you get arrested or worse, getting out of emerging markets because all those economies are slowing down, and trying to get into dollars. And when you do that, you can buy the US dollar in the form of our stocks and bonds, or you can buy gold, which a lot of people think of as a dollar-denominated asset. So gold stayed very close to the US dollar throughout all of 2014, down a little bit, but not much, just about 1%. But gold and the dollar together pulled away from all the other currencies. So to me, this is a strong dollar story, and gold actually did pretty well. So I would say it had a very good year in 2014, even though it was down slightly against the US dollar. It was up against everything else. That trend seems to be continuing, although if anything, gold is actually starting to lead the pack a little bit right now.
Well, thank you, Jim. And now we do have some questions from our listeners. So here's Alex Stanzik with those questions.
Okay, thanks a lot, John. Just a couple of very brief housekeeping items. Number one, we've got a lot of questions that have come in between both email and the questions that have been asked here in the webinar itself. We've got close to 24 questions at this point. We've got about 15 minutes left with Jim because he has another appointment that he's going to be stepping into. So we're not going to be able to answer all these questions, but we will try to get to some of these and get them answered. Second of all, the webinar has again hit capacity. It hit capacity within 30 seconds of us starting the webinar. For those who are not able to get in, we apologize. This is being recorded, and we will post the webinar on the podcast page of physicalgoldfund.com. So for the first question, Jim, this one has come in over email. Now, some of these questions, or some of these people are asking multiple questions. For the sake of time, we're only going to cover one question per person, and we're probably only going to get to a couple of questions here. But the first one here is from a person by the name of Ted G. And what he's asking, Jim, is if the price of gold goes up, don't they just mine more?
In the long run, yes, but in the short run, no. And the reason is that you can't just turn a mine on. It's not like throwing a light switch. I mean, gold mining is a very capital intensive, very long horizon business. You have to do, I mean, if you've been involved with mining at all, you have to identify a likely vein, you have to do feasibility studies, geology studies, environmental permits, you have to raise money. A lot of it's borrowed. You got to, get out there and get your equipment, and a lot of these gold mines are in difficult locations. Now, I realize that some mines have already been dug out and they just close them, and you can reopen them with a little bit less effort than I was just describing. But it's not a very simple thing to do, and gold has been very volatile. So if gold goes up, it doesn't mean you reopen a mine the next day. You want to see it stay there for a year or 2 years. Of course, in a world where maybe interest rates are going up, these capital costs could be going up as well. So in the long run, yes, a much higher price of gold at a sustained level will cause more mining and more output. But that can take years. That's not something that's going to change the price of gold in the short run, not at all. So that's the basic answer. Beyond that, and I'm not a geologist, I know a little bit about gold mining, but I'm not a geologist there. But all the reports I've seen and read say that, I don't want to get into peak gold, so to speak, but I have seen a lot of studies that say it's just getting harder and harder to find. I was in South Africa recently, and I spoke to people there, and they said, yeah, we're still mining gold, but, the quality of the ore is going down. We have to keep going deeper and deeper. Some of these mines are over a mile deep. They're not like, a couple hundred yards deep. They're a couple thousand yards, or like I say, over a mile deep. Some of them even more. It seems to be getting more scarce. It seems to be getting harder. It's not something that can happen very quickly. If you see just a run up in the price of gold, the mining output is not going to change that in the short run. Over a 5-year horizon, some more gold might come on stream. But bear in mind that demand for physical gold is voracious. The Chinese show no evidence of letting up, not just the Chinese government, but also Chinese civilians, Chinese population, people throughout Asia, India, and elsewhere. Yeah, maybe over a very long period of time, gold mining output could go up a little bit, but the demand seems to be right there. Gold's volatile. I'm not saying it's going to go up a lot. I certainly expect that it will go up exponentially, meaning 3, 4, 500% in the face of a new financial crisis, which I do expect. But leaving that to one side, just talking about more the steady state, I would expect gold to trend higher based on some of the factors we talked about earlier in the call. And mining output is not going to change that in the short run.
Okay, very good. The next question comes from Judson R. I'm going to paraphrase the question a little bit. Judson says, Jim, I'm a great admirer. You have made good points of the merit of gold under most scenarios. However, there's one scenario that I have never heard you address, and that is what to do about Japanese-style deflation in gold. So how would gold perform in a multi-decade Japanese-style deflation?
Well, I take that to mean, what if Japanese-style deflation came to the United States? And I think that's not far-fetched. I actually think the U.S. is Japan. We're 7 years into a depression. Japan's been in a depression for, approaching 30 years at this point, about 27 years. But I think the U.S. is in that rut. Now, it's very interesting what happens, because I said earlier that central banks cannot tolerate deflation. And it's not just a preference, it's existential, because there's too much debt. The way the United States gets out from under its debt is by inflation. We basically steal the money from the creditors by making the money worthless. So we say, okay, China, we owe you $2 trillion, fine, here, we'll print it up, here's your $2 trillion, good luck buying a loaf of bread. I mean, that's a little bit of an overstatement, but I think listeners take the point that historically we get out from under these kind of debt burdens by inflating the dollar, making the dollar worthless, which hurts the creditors, but too bad. At least that's the way the United States government thinks about it. But there's more to it than that. Tax collections are a big deal. Now, everyone's saying, oh, gee, you pull up at the gas pump and gas used to be $4 a gallon, now it's $2 a gallon, and let's just say you use 100 gallons a week in your pickup truck or whatever. Well, that's $2 a gallon, 100 gallons a week, that's $200 a week in your pocket. All of a sudden, you've got $200 more in your pocket than you did before the price of gas went down. But the government can't tax it, right? And there's nothing about a lower price of gasoline that changes your tax bill. You still owe what you owe. So you're getting the equivalent of a $200 a week raise in the form of a lower gas price, but the government can't tax it. Well, the government hates that. They hate it when you get a raise that they can't tax. So that's the asymmetry. An economist would say, if I gave you $200 more in your pocket in the form of a pay increase, or if I gave you $200 more in your pocket in the form of lower gasoline prices, it sounds like it's the same thing. An economist would say, yeah, it is the same thing. You got $200 more in your pocket. But to the government, it's not the same thing. If I give you a raise in your paycheck, I'm going to tax it. But if it's a lower gasoline price, I can't tax it. So there's an asymmetry there. It's another reason governments favor inflation. So they want inflation to prop up the banks because it's easier to tax those gains and because it's the only way to pay off the debt. So what happens if you get deflation? That was the listener's question. Persistent deflation. Well, it happened once before. It happened from 1929 to 1933. Actually, it started before the crash in 1929. It started in 1928. The U.S. had about 30% deflation over that 5-year period. And guess what happened? The price of gold went up 75%. In other words, if governments get, because of all the reasons I mentioned that governments need inflation, if governments need inflation and they're not getting it through money printing and they're not getting it through QE and Operation Twist and currency wars and forward guidance and all the bag of tricks that the Fed has, if they're not getting it, governments can always get inflation, always get it, just by raising the price of gold. So that we won't see the government arbitrarily raise the price of gold in the short run because they want to pretend this problem doesn't exist. But if they get desperate enough and you actually do get into a Japanese style deflation, don't be surprised if the government takes steps to raise the price of gold, because nothing happens in a vacuum. If gold goes up, guess what? Everything else goes up. Silver, oil, copper, bread, wheat, beef, everything goes up. That's why they do it. The government doesn't increase the price of gold because they're nice guys or they want to enrich gold investors. They do it to cause inflation. And so if you get real long-term, persistent, deep Japanese-style deflation that just won't go away, don't be surprised to see the government raise the price of gold. They did it before. They did it, and actually it's been done many times, but most famously in 1933 when the price of gold increased 75%. If you go back and look at the New York stock exchange prices during the Great Depression, when it dropped 90%, the one stock that went up was Homestake Mining. It was a gold miner, and the price of gold went up, as I say, 75%.
Okay, very good. This next question is coming from Juha M. And I've actually heard this said before, Jim, about you, in that sometimes people refer to you as an insider. In other words, you come from sort of the pedigree and the league, so to speak, of people who have very high positions either in government or amongst hedge funds, etc. And the question was basically, considering that you're an insider, why did you write your books, Currency Wars and Death of Money, and how have other insiders reacted to your books? For example, people from the Fed, Pentagon, etc.
Wow, that's a good question. It's funny because I'm actually doing this webinar from Washington, D.C. I'm down here. Usually I'm up in Connecticut, but I'm down in Washington today. I have some meetings on some counterterrorism finance issues tonight that I'll be getting ready for after the webinar. Well, I'll tell you why I wrote the books. That's pretty simple because, I'm not going to call myself an insider, but I do meet with officials of the Federal Reserve, including Reserve Bank presidents and members of the Board of Governors. I do meet with people in the national security community. I do meet with people at the Pentagon. I've been a guest over at the Treasury. They've invited me in for seminars. They've invited me to give, presentations behind closed doors to, their risk management groups, et cetera. So suffice to say, I've had a lot of contacts with the U.S. government, which I'm very happy to do. Some of it as consulting, a lot of it's volunteer work. I was certainly one of the people called upon after 9/11 to help out. I happened to have spent a fair amount of time in Pakistan earlier in my career, which I wrote about in my second book, The Death of Money, how I was involved with Islamic banking in Pakistan. And so I was able to contribute. And I did quite a bit of that work as a volunteer. I was also very involved in recruiting other volunteers to help out on the national security side. And I have to say it was very gratifying that I was never turned down. If I picked up the phone and called a friend on Wall Street or a friend in the hedge fund community and said, could you come down to Washington or Northern Virginia and meet with some national security officials, no one ever said no. So as I say, it's great to see that kind of patriotic spirit that we all applaud. But having said that, and you spend a lot of time in that milieu with IMF officials and others, I became very aware that the insiders, at least the people in the know, always win. They always win because they can see it coming. They're involved in the decision-making process. They know how to get out of the way. And it just bothered me that everyday Americans who are as smart as anybody you meet anywhere, but look, you can't expect a dentist or a doctor or a lawyer or a teacher or a fireman or a policeman or a construction worker or a truck driver. You can't expect those people to have a PhD in economics in their back pocket. That's unrealistic, but they're people who work hard for the money. I hated the idea that that money could be stolen from them through policy. And so I understand the policies, but I also felt that there had to be a place for a book that was written in plain English. Now, if I may say so, what I focused on in my books, it's PhD level content, but it's written in plain English. In other words, there's nothing about my books that's dumbed down, but it is simplified. When I say simplified, I mean, you can use plain English, you can use metaphors, you can take fairly sophisticated comments and, and explain them to people in ways that are pretty easily understood. Some of it's not even that difficult. I hear someone say, talk about something like sticky wages or downward nominal wage rigidity, and I say, oh, you mean people don't like to take a pay cut? Well, if you say people don't like to take a pay cut, everybody understands that. Nobody likes to take a pay cut. So why do I have to say downward nominal wage rigidity, which means exactly the same thing? Well, one is the way you would speak in the faculty lounge at Harvard, and the other one is the way we would talk at the bar. So I want to write a book for all Americans that were really people around the world, because my first book is in 10 languages and my new book is, I think we're up to 6 languages and we're still working on foreign sales. But so I wrote those books not for the academic crowd, not for policymakers, but for everyday Americans, so that just to level the playing field, you can be interested in what I have to say or not, but at least I know that I said it, and try to level the playing field, give people some insight into how the elites are thinking. Now, you say, well, how do my let's call them, lead friends or policy making friends react to the books? It's pretty interesting. There's a lot of interest. It's funny, even people who don't like to think that that conversations are going to be scrutinized, they kind of like to read about themselves in some way. People are very interested in it. People do read the books. You actually end up maybe getting more invitations because people want to talk to you to see what you've been doing or where you've been traveling, and I do get a lot of speaking invitations around the world, and that's a lot of fun. So not just fun, but an opportunity to talk to people. I was in Istanbul recently. I met with one of the members of the Central Bank of Turkey. I met with the head of the Istanbul Stock Exchange. I was in Korea not long ago, and I met the head of the Korean equivalent of the SEC, their lead market regulator. So I do have a lot of experiences like that are opportunities presented because the book is popular, and then those are experiences I can use to learn and hopefully offer more. So it's a good process. I'm glad I did it, but that's a little bit about my motivation and background for doing so.
Very good. Thanks for sharing that, Jim. That was really great to understand from you. So with that, I understand that you are pressed for time as you always are, so we thank you very much for taking the time to share with us, as well as thanking all of our listeners. I want to, at this point, hand it back over to John.
Yeah, thank you, Alex, and indeed thanks to you, Jim Rickards. On your way, I know you have to get to a meeting, but it's been great having you with us here today. Much appreciated. And thank you to our listeners. It's wonderful to have you with us. We appreciate the questions. Sorry we couldn't get to all of them, but they were very valuable and useful questions, and we will always welcome those from you. Just to remind you, you can follow Jim Rickards on Twitter. His handle is @JamesGRickards. And let me remind you that you can find Jim's latest book, The Death of Money, at Amazon or any good bookstore. So get yourself a copy if you haven't already. It was wonderful to hear Jim talking a little bit of the background of the writing of his books. So goodbye for now to all of you, and we look forward to joining you again soon. You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.